Mortgage Pros 411. I am Audrey Boissonou with my co-host Kevin Casey, and we are joined today by the illustrious Bill Lowman.
Hi, everybody.
Hey, Bill, how are you?
I'm good, thank you. How are you?
Just peachy. You know why? Because I'm in the mortgage business and everything is perfect. Perfect.
What a
Okay,
ride.
so we're going to start with, let's start with, we've got a few NMLS classes coming up because NMLS is sending me emails going, you haven't done your content, which I will be doing shortly because I teach this stuff. So Kevin, you want to tell us when we're doing those live
in person with meals provided, sometimes even snacks like chocolate chip cookies and such. Keep you
Don't
going.
promise specific snacks. We can't deliver on
we gotta work on those. I gotta get a sponsor for the chocolate chip cookies.
Really?
Thursday, 24th of August in Daly City at the Lake Merced golf course, a gorgeous golf course with beautiful views. And so if you get bored of the speakers, you can just look at that gorgeous view if the fog doesn't roll in.
You know what? You might get bored with Kevin, but I will not be boring. I promise you.
September 22nd, we're down in Ventura, Greater Ventura, for a live class down there, and then back.
Thousand Oaks.
Yes, and then back up Monday, the 25th of September, in Sausalito. So that one hasn't been mentioned officially. That's the first anyone's mentioned it. By the way,
you know what we should get a sponsor for? We get a sailboat to pull up to the dock at the Sausalito Yacht Club at 4:30 or 5 p.m. whenever we're done with that class that day, and we go sailing in the bay. How's that for a great freaking idea after an NMLS class?
You know, I know one of our attendees has a sailboat right there in the thing. It's a gorgeous yacht. So
well, and I might or might not have grown up sailing, so I might be helpful as a deckhand. So
you know,
the
former CEO of Encompass, before they started selling, and you know, now they're ICE or whatever, had a big yacht that you would see in the bay.
Where? Where's he? Can he pick us up? Bill, I'm putting you on this.
Their office was in
September 25th. A yacht will arrive at the Sausalito Yacht Club after our NMLS class is over and pick us up. Bill, make it happen, okay?
Yeah, you got it.
all right.
Thank you. Thank you. I believe him. Do you believe him?
Yeah.
Okay, so as always, there's a lot going on out there, kids. So let's start with, so I get a slightly panicked message from Bill last week. We won't say, unless he wants to, how he phrased it, but there's a new development, let's call it, going on. Tell us about it. And do you say Basel or Basel?
Oh, I say Basel when it comes to international banking standards. I say Basel when it comes to Basil Hayden and the bourbon I like to drink. So
there we go.
Good to note. All right. So
and it wasn't a dramatic or whatever you said. All I simply said was, are you covering the existential crisis to our business in your next show?
Yeah, and if anyone is unfamiliar with the term existential crisis, I would encourage you to Google it to see how urgent it sounded. With that being said, filling the slot felt very urgent at that moment. So anyway, Bill, tell us what's going on.
Sure. And, Audrey or Kevin, please feel free to interrupt me. Like Audrey needs permission for that.
Yeah, you don't need your permission.
So I probably didn't even need to say that, but if you want to stop me through any part of this to ask a clarifying question, because, I kind of live in this stuff, but when I read it or talk about it,
trust me, we'll help you translate. No problem.
And so I don't want to I might spin my own head. So,
no, we'll bat you over the brain and we'll make sure it all makes sense. Go ahead.
So the final implementation standards for Basel III, and Basel is simply a set of international banking standards. And there's been Basel I, obviously 2, 3, blah, blah, blah. And the Federal Reserve, FDIC, and OCC have banded together to issue new standards for all banks. Okay, that's great. I'll start with, I think a theme in this is going to be that you're going to hear is that through these standards, the FDIC and Federal Reserve and OCC have overcorrected based on the regional bank failures. And now they're kind of flexing their muscles, overcorrecting based on the bank failures that we saw with, Silicon Valley Bank and Signature Bank and those. So what they are doing is they're going to be increasing the minimum capital standards for all banks by about 20%. So what that means is you have to have more capital. They have to maintain more capital on their balance sheet. When this happens, then banks may have to go through and pick and choose what businesses they choose to stay in, or maybe choose to exit based on the capital standards, because they have less capital to deploy, if that makes sense. So
they'd want to do more credit card lending than mortgage lending, because as rates go up, credit card rates go up right along with it. And so
that's right. And so many other things that how a bank could deploy their assets. So here's where, so now you have that as the backdrop. Now let's go take a look at how these banks and how these standards are going to affect mortgages. So certain assets carry a certain risk weight. Okay, so some assets are deemed riskier than other assets. Through these standards, they will be increasing the risk weight on single family residential mortgages.
Okay,
So,
just hang on there, because I read it was for LTV specifically over 80%. So does it cover all single family mortgages or just those with an LTV over 80%?
it will impact higher loan to values more,
Okay,
but it's going to impact all mortgages.
all of them. Got it.
And so this is all relatively new that it has come out. I sent you that dramatic text saying existential crisis. These new standards that I'm talking about is part of an 1,100 page document. So industry associations, Mortgage Bankers Association, American Bankers Association, everybody's now going through all of these 1,100 pages looking for more details, devils in the details. So there's going to be more coming out on this, or perhaps even less. Maybe what at an initial read, you'll say, oh, this is a certain impact, but maybe it gets mitigated later. This is, but this is, as we know right now. So if you have increased risk weight for single family mortgages, here's where I go to immediately that I think is going to potentially impact all of us that are on this call. And that is an area that's particularly challenging right now, and that is jumbo correspondent lending. So, I know I'm sitting here with not only the host here, but a lot of people that are in coastal areas, do or have done historically a fair amount of jumbo loans. Well, if the banks have to risk weight these to, a greater extent, which they will, the best thing that could possibly happen is your pricing gets worse. Right. Think about that today.
Yeah, that's great.
The worst thing that could happen is they get out of the business and saying, this is risk weighted too much. I'm not going to deploy my capital on jumbo loans. Or what we see sometimes with banks is we'll deploy jumbo capital for our deposit base and our high wealth customers, but we're not going to deploy it in the correspondent channel where we're buying it from you and you and you and you. So I think that is
now that works really well for First Republic, didn't it?
Yeah, right. Good point. So that
was the number 4 jumbo lender last year, and now it doesn't exist at all.
Right. Yeah. Again, and so what I said earlier, here's an overcorrection, right? Yeah. This is a lender in the banking crisis that had too many jumbo loans on their books, and now they're overcorrecting. That won't happen in this. The other thing to keep in mind is just, banks like Chase and Truist and others, Flagstar, they buy conforming loans. They buy regular loans, not just jumbo. Now it's going to impact them. CRA loans. Sometimes we have opportunities for to sell loans in affordable areas to banks because they're meeting
Reinvestment Act. Yeah.
their CRA requirement.
Yeah.
So it's just, there's going to be, you know, a lot of potential impact there.
Okay, so let's just take a second and just recap. So if this is implemented through this overcorrection, which what a shocker that federal agencies would be overcorrecting, it is going to tighten further what is already a tight credit market. So I think I mentioned to you last week, we were talking to Bill Dallas. We were talking about the SLUICE report that had just come out, which is the Senior Loan Officer Opinion Survey, something to that effect. We're, you know, basically, what are you seeing as far as lending goes? And the answer was everything's tightening up. Credit is tightening. And so here we are, we already have tightening credit, and now we potentially have banks, and this impacts independent mortgage banks, which is all of our wholesalers and a lot of the retailers. So just don't think that you are not part of this. If you are on this call, you are absolutely impacted no matter what your position is. It's going to impact everybody, correct?
Oh, that's exactly right. And I'm going to go through more things that might even, I personally think, are going to have an even more profound effect on our business. But you hit the nail on the head. This isn't just a bank thing. And I think sometimes when this initially came out, too many people thought, oh, this is just a bank thing. This has far-reaching effects with every independent mortgage banker in the country.
And it also impacts servicers, correct?
Huge. Let's get to that.
All right. I'll just stand down and let you do your thing. Chop, chop.
Well, no, these are all great questions.
We got a lot of ground to cover. Let's go, Mr. Lowman.
And I couldn't get you to not interrupt if I tried.
That's not going to happen.
So through these new standards, they are going to be putting in, or it's actually reimposing, because it was imposed at one point in time, reimposing a cap on mortgage servicing rights to 10% of their overall capital. So now you have increased risk weighting and a cap on how much of your overall capital can be mortgage
Explain that. Like, put that in layman's terms.
Translate that to
layman's terms, baby.
So if there's let's say the Bank of Kevin has assets of $100 million, you can't have more than $10 million in mortgage servicing rights. And if you wanted $20 million, you couldn't do it. So now, you know, you have to allocate less of your capital to mortgage servicing rights, and you're not free to allocate whatever you want in mortgage servicing rights. Keep in mind, a mortgage servicing right is created on every mortgage loan that's done. It creates a mortgage servicing right, and it is the most, in my opinion, the most important and the most volatile impact to how a loan is priced.
Just MSRs, guys. When you see MSRs, it's mortgage servicing rights.
So
that term bandied about quite a bit. Nobody ever knows what it means.
So in doing a cap like this, it's going to, by design, decrease demand for mortgage servicing rights. If demand is decreased, it's going to negatively impact how loans get priced. That was a great question on there, by the way.
I was just going to say,
at $100 million, would we ever see Kevin again? Of course you would.
No, God, no. He'd be long. If he had $1 million, he'd be long gone. Okay, so what about warehouse lines?
Connect. Let me connect another dot on this.
Okay.
With the risk weighting being greater on mortgages, the lifeblood of our industry is the liquidity that we create. We get warehouse lines.
Yes.
And that's how, American Pacific, every company, none of us, unless you're a depository, we don't have cash in our basement that we use to make our loans. We have warehouse lines.
Right.
In addition to that, and I'm going to go back to the Bank of Kevin example, and another thing that provides liquidity and working capital for lenders is MSR lines of credit. What is that, you ask? Let's say the Bank of Kevin has $100 million in mortgage servicing rights.
Okay.
Generally speaking, you could go out to Flagstar, Western Alliance Bank. I could go on, banks that are going to be impacted by this, but you could go out to those banks and you could borrow about a 60% LTV. You could borrow $60 million against your $100 million. So now the Bank of Kevin has all these mortgage servicing rights, but he needs liquidity. He needs cash to run the business. He needs cash to invest in technology. He needs cash to go recruit new loan officers, whatever it is we run our business. So the mortgage bank of Kevin takes $100 million of his servicing rights and uses it as collateral to borrow $60 million. Because of this risk weighting and the imposed caps on MSRs on your balance sheet, you are going to see potentially a squeeze. Banks choosing not to get into the warehouse business. Now, where do we get the money to lend, or not provide MSR financing? Where do lenders, and most of us hold some form of mortgage servicing rights, where do we get the capital that we need, the liquidity we need, to borrow against it to invest in our business? So this, and keep in mind, and it's a little bit quiet, but in the last 90 days, for a variety of reasons, but 2 lenders got out of warehouse lending. Fifth Third Bank and Comerica. So, this was one of the biggest challenges coming out of the crisis in 07 and 08 was there were very few people that would do warehouse lending. Now, if we see the pendulum swing, because banks have to choose to maybe not do certain lines of business because of these new standards, and they choose something else. Well, I'm not going to choose anything mortgage related because of the risk weighting and the capital requirements. I'm going to choose to do something else or create other assets for my bank. So
they're going to send us back to Vito and Guido.
Well, so, this is how, when we talk about this, yes, these are standards for banks, but the impact is far reaching and impacts all of us. So, it's not just a bank thing. And these banks, by count, there is about 40 banks that would be impacted by this that largely serve the mortgage business.
40?
Today. Yeah, so there's about a 2 dozen big banks and another dozen-ish regional banks. So this, again, overcorrecting, but I don't think, it's going to be, I don't think the far-reaching effects into our business is well known. So look, we lose our lifeblood. If we don't lose it, it's going to be harder to get warehouse lines. What bothers me about that, I'll tell you this, is, will warehouse financing go away? No. Will there be less of it? Likely. And then who are they going to go to? They're going to go to quick. The big guys,
they're going to get bigger.
They get the treats. The big guys get the treats. The little guys, who I think are important to our business and providing a free market and competition and all that, the little guys don't get the treats, right? And so, and this impacts pricing. And, when you think about pricing, as an industry, when we talk about this, don't talk about it. I don't like talking about it saying, God, our pricing is going to suck. What that really means is this is going to negatively impact the consumer.
Right.
So this overcorrection to be the savior of banks, who ultimately gets harmed is the consumer. And right now, you know, our consumer, us as, you know, as an industry and our consumers, we're trying to absorb like the holy shit of a 7% interest rate.
Yeah.
And now we throw standards on that make it even harder.
Yeah. Okay, so I was on your tail a few days ago saying that there needs to be some sort of something that an LO could do and that the industry can do to let the regulators or the legislators or the whole world or whomever we can know
Yep.
what's going on and impact change. That's the only way, is to make a big, huge fuss about this, just like we did with the LLPAs, which only worked halfway.
Yep.
So, or not even half, maybe like what was that, 15%?
Well, you got rid of the DTIs. That was
Yeah, the DTI was what, 15%? Then it, anyway, the bottom line is something's got to happen. So is NBA working on something? Because I will be asking if NAM is working on something too.
Yeah. So can we add one more thing to this? As this becomes more and more public, you're going to see that these new standards take effect on July 1, 2025. So that's what, 2 years away?
Yep.
Don't be fooled by that. While is that when it is official? Yes.
That's
If this passes, you know, through the vote of the Federal Reserve Board's 11 person board, if that passes, banks will begin implementing immediately.
Right.
You will see it. I mean, banks don't wait for this stuff.
Right.
Yeah. So
wouldn't they also be doing stuff right now because they could see it passing?
Well, say that again, Kevin.
Wouldn't they start doing things right now only because it's been proposed and, you know, hey, start hedging your bets?
Yeah, I don't think yet, although, you know, that as an example, a lot of us lenders have meetings set up with our warehouse banks. And we get beyond the rep, but we get their upper muckety mucks coming into conferences, and we're going to be at the Western Secondary. You know, how they see, that's going to be the number one thing that I talk to them about at my meetings is, how are you viewing the world? How are you viewing this? You know, if it passes, are you going to, you know, right away, do you think your bank would opt away from mortgages if, you know, this were to happen? So this will be, you know, a big topic. So I will say that this is not as necessarily easy to create a groundswell of support. So,
but there is a comment period through November 30th.
Right. So let's go back. If this was a matter of, you know, 3 banking regulators. So the times when we've gone through, you know, what the NBA calls their Mortgage Action Alliance,
right,
where you rally people, write your congressman, you can certainly do that. This is not a legislative matter.
Yeah.
This is a regulatory matter. So that, you know, probably goes over the head of your local congressman, to be honest with you.
I'm sure it would, but we got to figure out a way to communicate.
So what I would encourage is, you know, one, you know, comment. You have a comment period. Feel free to comment, and don't feel like you need to be an expert to comment. And I would just strongly, if anybody chooses to comment, mention the consumer and mention the impact.
Bill, I think there needs to be an easy way for somebody to weigh in on this. And so again, I'm just going to stay on you about this. I think that that's something
Feel
that
free.
NBA and NAM could organize to even together, where they're figure out who we need to communicate with, how we communicate. There needs to, you can't just say, oh, go ahead and write a letter.
Yeah. And you know, feel free to do what you want. I'm going to suggest that Audrey marches to Washington and all you guys join her, because she feels like the associations don't do enough. So I'd like her to take it on her own hands and talk to your national association and ask them for talking points. NBA is going to be providing some for people to write. I would get it from, if you're part of other associations, get the talking points that you can include in any comments. always mention the consumer.
100%.
Nobody listens.
The only
then,
thing anybody cares about is the consumer. They don't give the slightest crap about what's happening to us. So always the consumer, no matter what you're talking about with these guys, right?
and then help Audrey with picket signs. I can tell you where the Federal
Okay,
Reserve
okay,
headquarters-
smart ass. That's nice. Yeah.
In front of the Fed?
Yeah, can you imagine? Oh my God. Okay, so we but again, Bill, this is where, you know, the NBA is organized, NAM is organized, you have the call to action mechanism. And I know that targets legislators, but there's got to be, I don't know, I feel like we need to think outside the box on this one to make sure that the message gets out there, because otherwise it just happens to everyone and then it's a nightmare.
And
So
like,
we
oh,
have
wait, what happened?
we have a couple questions.
and Kevin, I don't necessarily, you mentioned that, you know, and I get why you're saying it, but why it might be considered a foregone conclusion that this gets passed. The first standards from Basel I, II, and the first part of 3 were all unanimous, which was 11-0. This vote was 7-4 in favor. And Chair Powell has recognized some of the challenges, let's say. So I think, you know, the work that has been done leading up to this vote and most recently, I do think it's not falling on deaf ears. Let's just say that. So
that's what I'm saying. We need to be screaming. I mean, sweetly, of
I mean,
course.
it worked the same thing when the LLPAs came out and they had the DTI. And
I still think that was wag the dog. I think they threw that DTI thing in there so that it would distract everybody and we'd focus on that. Then we would focus on everything. And then when they gave that one back to us, they got to keep what they really wanted, which was the money. So, okay, we have a question here. Will the MSR capital requirements have more effect on portfolio lenders than on IMBs, in your opinion?
no, I think it'll have an equal effect on everybody.
So we're all screwed. Great.
Yes.
Okay. So Dirk has a comment. Great way to crash the economy, put us into a deep recession and get rates back down. I feel like that's not going to happen. We want it to, but
you know, it's really interesting because, you know, you mentioned the coast. I mean, because it does affect the coast the most if jumbo market goes away. And the rest of the country that, you know, they can afford it. It's like, no, wherever the coasts go, the rest of the country goes. So
and values have gone up.
So does the rest of the country.
And also the values have gone up all over the country. So $1 million is not the same $1 million it was 5 years ago. It's impacting people all over the place. All over the place. We have a comment here from Jill. I need to increase my cardio. Let's march, Audrey. Oh my God. Okay.
Let me know when you get there. I'll fly, but I'll meet you there.
Oh my God. Yeah. Let me tell you something. I've been told by people, oh, you have too many opinions. You're too loud. You are too confident. You are this, you're that, all this crap.
So I've been told that, and I'm told to keep you under control.
Yeah. Kevin has been told that he should control me more. So yeah, that's working out. Anyway, let's move on to, speaking of overcorrections. So there was a great piece that our friend Dave Stevens, who we love so much, wrote and published in Housing Wire, and it's an opinion piece. It says the GSEs are targeting IMBs on buybacks, and man, he was brutal. Did you see this thing?
I did.
Oh my God, he said everything that should be said. Like, this is why I like him. He just says it.
Doesn't hold it back anymore.
Huh?
He doesn't hold anything back.
He doesn't. He's like, oh wait, this sucks. Let me talk about it. Oh, and he's credible. He's done a lot of stuff. So, Bill, IMBs, buybacks. We've talked about it on here before a number of times. It's a humongous problem. It's not getting better. What are you hearing out there?
Well, I'm not only hearing, but what, you know, experiencing every day. And, you know, the reality is we're seeing more and more loans getting pushed back from the agencies for repurchase.
And how long have they been making their payments perfectly, Bill? Tell me.
Yeah, some of them have been. And some of them are for documentation challenges and others. But, you know, we see, I would say, more way more than half are performing loans.
Wow.
Yeah.
And they're still making you buy them back.
Yeah, and you know, there could be a lot of reasons for that.
I have a few
One of
ideas of what
which-
they are.
One of which is, you know, they see lenders' financial statements. I think they're concerned that certain lenders are either going to
Right.
go out of business or get acquired, and that they're going to lose their ability. They're going to lose their counterparty. So
Wait,
let's be aggressive and
nobody in the
push them
LO
out.
world knows what counterparty means. Define, please.
Us lenders.
Yeah. They're not gonna have the ability to go back to that lender to
Because
take
the
that
Bank of
loan.
Not if I'm gone.
Right, so
If that
the
lender
bank-
isn't there.
So if the Bank of Kevin sold to the Bank of Audrey, I'm out free and clear. I got my $100 million. I'm afraid.
That's what they're
And then
concerned
Fannie
about.
comes back after the Bank of Audrey now because I'm no longer there to go after. So
Yeah,
I'm not
and-
buying
and-
shit from the Bank of Kevin, let me tell you. So I would highly recommend reading Dave Stevens' article in Housing Wire because he really hits all of the high points and talks about how there was an agreement in place that was made between the GSEs and FHFA about the reps and warrants challenge a long time ago. And that it was decided then that intentional fraud, they're going to just have no mercy, which is how it should be. And if you're constantly doing the same thing over and over again, they're going to go after you. But this is different. This is apps. And why are you doing this? And again, we will, so I had railed on the Fannie Mae profits that they had posted for Q2 a couple weeks ago. Freddie too has come out and shared their profits. I mean, do you know any other entity in mortgage lending that is making money right now other than the GSEs, Bill? Anyone?
Nope.
No.
And so,
So how the hell is that okay? I'm so
Well-
sorry, guys. Oh, God.
so I'll explain what Audrey meant when she talked about what Dave said about, you know, what was agreed to in a framework between FHFA and the agencies. And there is a framework that there is essentially a waterfall of alternatives to repurchase that they are supposed to follow, especially if a loan is performing, which would mean one is we could indemnify it, which is, okay, I'm not going to buy it back. If the loan ever goes into default, then I do buy it back. But if it performs and there's an agreement, I'll sign the indemnity agreement.
right,
So I don't have an issue as long as the borrower continues to make their payments. That's one. Another potential alternative remedy is essentially the lender, we pay an additional, call it an LLPA, after the loan is funded because it's a higher risk loan. So I'll pay, you know, a risk LLPA. And so I'm paying, you know, $15,000, not repurchasing a $500,000 loan. That's another alternative remedy.
right.
But we're not seeing that. We see very few alternatives to repurchase today.
Yeah, he
But
talked
what-
about
but
that
what
with
David-
us. Yeah, go ahead.
What David said is that they're being a lot easier on the banks than on the IMBs. And that's a bunch of hooey. And because they think, okay, again, it goes, I think, back to reps and warrants where they think, well, the banks are going to make it through this, but maybe the IMBs won't. And that way we're going to cover hedge our bets.
Exactly right.
Yeah,
but-
go back to YouTube and watch our David Stevens interview. He talked a lot about the details of this.
So go to our YouTube page. Oh God, Kevin, we didn't do it. We had promised we were going to go back and like recap these things and remind people to go watch our YouTube channel and blah, blah, blah. We never do that stuff. We just dive right in. There's 500. I have a list so long. That's why I keep pushing you. I'm like, let's go, let's go. But this stuff is so important. So why does this matter if you're an LO? Okay, let's say your condition list is long and hard, right? Granted, some lenders over condition. I hear you. I experienced it. I know. But if they're asking you hard questions, it's because they are making sure that they aren't going to have these problems on the back end. Appraisals and income. Those are the number 1 and 2, not necessarily in that order, right, Bill? Problems. And so they're grinding us. And so I was telling Bill about a situation where I got whoops, I wasn't going to say their name. Well, there we go. I got an AI approval, and And then by the time we got through the appraisal and sent all the final stuff in for the final blessing from the underwriter, the whole thing was undone because it was a complicated file. The AI didn't read it correctly. And so it's complicated. You've got AI reading income, and then you've got massive, have you been able to track like what percentage of the files that you're getting questions on income were blessed by AI versus a human? Do you have any numbers on that?
Yeah, 99.9% human.
Wow.
Shit.
Wow.
That's bad news.
Yeah, that's crazy.
That's
I
really
mean, I
bad news.
got an example of a loan that I closed back I don't know, mid 2021, I think it was. And this is just something that happened after a close. It dawned on me. And so we closed the loan like October 22nd. And the taxes for the previous year had not been filed and by the borrower until October 15th, which was the extension deadline, right? But the loan didn't close until October 22nd. And the underwriter never asked for the completed tax returns from the previous year. And I'm thinking, I wonder if that would create a buyback for that lender. That particular deal was brokered, but is that something that would come back as a buyback? Hey, you didn't get the supplemental tax returns, and yet you still closed.
Yeah. So in a situation like that, we get from Fannie or Freddie, you essentially get, it's called a deficiency letter.
Mm-hmm.
And it says you didn't provide the most recent tax returns.
Right.
Before we respond, we go back to the loan officer and say, Kevin, would you go get those tax returns? We just,
Yep.
And then you
Yeah.
say,
I've done that with us.
Yeah.
you say, of course, and we get it, and we go, oh, here it is.
Here they are.
That was every loan with Wells Fargo that we ever closed was
Yeah.
a long list of I would tell my borrowers, I'm like, look, you're going to get a great rate. You're going to have huge conditions up front, in the middle, and after you close. So get ready for it. They'd be like, all right. Right.
Yep.
So it is. And by the way, in my situation, I believe the underwriter was correct in the conditions I was receiving. It was the AI that read it wrong. It wasn't the underwriter. I think that the way that she structured my particular deal was the right way to do it. And so I'm not faulting her. I'm just wondering, we've got all these different stops in the middle, the LO underwrites it, then the LOA underwrites it, then the processor underwrites it, then the underwriter underwrites it. I was telling Bill about a deal that I couldn't even get it past. I brokered it. I couldn't get it past the front desk because they Googled the property and thought that it was something it wasn't. Like there was, they thought they were, and I could not, it was just insane. So it's so complicated out there. So as LOs, we need something that we say to our borrowers. So when when the borrower's saying, why all the conditions, why is it so hard? This is why. It's because the federal regulations are so outrageous and out of control at this point that if they want the money, they're going to have to play ball, but we have to be aware of this so that we know what to say, right?
Yep.
Yeah. Holy guacamole. That's all I got to say. Okay. So I challenged Bill in the beginning, before I said, hey, so in light of all of this, could you think of some nice, good things that are happening in the mortgage industry? So Bill, I don't know how many you came up with. Let's try one. Do you have one good thing that you can share with everyone?
Before we do that, can I go back to this?
Yeah,
Oh God.
And just add something.
Yeah.
And then I'm just going to give you time to come up with something. You see, I believe Bill Dallas was on your show and talked about credit tightening, and you see lenders, or you see lenders are tightening credit. I think it was even said here's what happens. And I'm not saying this is happening at APM, our company, or any other good company out there, but it very well could be. So we got a lot of, let's say a lender gets a lot of deficiency letters and buybacks on income. Well, that lender is going to tighten up how they underwrite income. It doesn't necessarily mean, oh, we're going to lower our loan to values, or we're going to, raise our FICO minimums, but we are going to be tighter on how we look at income. And it has a broader effect of that, or appraisals. Because you were right, Audrey, the top two in the industry are income and appraisals for repurchases. So you see lenders looking at this and getting a little bit tighter on how you underwrite the areas that you get the buyback. So, okay, now I got to come up with
Well,
something.
and just to be clear, I did ask Bill if there was like, is there like a credit committee that sits around deciding what's going to happen next and, and how you're going to handle this. And it really is being driven by those buybacks and what the repurchase requests
Yep.
are. So there you go. So do you have one, Bill? Do you have anything? What's good?
I have two things that
I
are
want
good.
one. Give me one. We're
I'm going to
gonna
give
space
you
them
two
out.
because these are so good. I
Okay.
need to share them. So first one, whenever this thing goes, whenever this
Market changes.
hit ends
Yeah.
after today, we're one day closer to the end.
Wow. Okay.
All right.
All right.
And
That's all you got?
two, I think the other good thing is, look, 2020 and 2021 were clearly heydays. A lot of business, a lot of volume, a lot of everything, right? And I think that this market could use a cleansing, so to speak.
Oh, yes.
And the people that are students of the industry, that
Yes.
care about their business, the people on this call are the ones that are going to survive. Is it
Yes.
going to be tough? Heck yeah. But the people that need to be kind of cleansed, they're not on this call. They're not
Yes.
students of the industry. And this is actually good markets for you because it's too tough for them.
Yeah.
It's just hard as heck for you.
Yeah,
But it's
yeah.
too tough for them.
You know
So
what the trick is though, is that we need the bar to getting back in to be higher because we have a whole group of people who get in and out based on whether it's easy or not easy. And
would you do something about that?
listen, Mr. MBA, you do something about that. Good Lord. Okay, so that is a great
So
point,
Audrey,
Bill.
what are you saying is you want us to have more courses that we have to take each year and
Listen,
you want,
we got to do something so that the people who are not truly committed to this as a profession get out and stay out. That's it. I mean, and then, this is not a part-time job, in my opinion. I mean, otherwise you're reduced to, did you read that little bit about the Beverly Hills realtor? He pled no contest because he was burglarizing celebrity homes. Like, so I guess he didn't have enough closed business. So he thought, you know what? it was like a Robin Hood thing. I'll just take from the poor. But if you're a realtor, I would highly recommend not burglarizing your clients or properties that are on the market. What do you think? Is that good advice for today?
Wow.
or drinking their milk. That was the other one.
Wow.
Some realtor
Wow,
did.
really? Okay, so I thought there is business out there, and actually we're going to have Trisha James on next week with Champions Funding, Champions Mortgage, Champions Funding. I don't know. Anyway, and she is a force of nature. We've had her on here before. She is
I'm looking at some of the comments. So I came with something positive, and Dirk says we're also one day closer to death. Thank you, Dirk.
Oh, Dirk is always full of little gems for us.
Oh, that is a gem.
I had somebody ask me not to curse, but I do it so rarely on this show, and occasionally it pops out.
What,
it just is
loan
what it
officer
is.
doesn't?
What?
What loan officer doesn't?
Well, apparently there's one, but anyway, so yeah,
we cannot curse. I'll commit.
We are so well behaved on here most of the time, so it is what it is at this point. So and then Catherine had asked, what is this new law? It's not a law. It's what would we call this thing that the FDIC and OCC and the Fed are working on? What do we call it? It's not a law.
It's banking standards that are going to be imposed
okay.
on banks.
Okay. So to summarize very quickly, it would be an increase in the amount of reserves they have to have in order to be doing or servicing mortgage loans, correct? Is that a capital
that is essentially collateral for what they were doing. Yep.
Because the Fed is
actually reserves is not a bad way to look at it.
Thank you.
You got to have capital in reserve to back up the mortgage stuff that you're doing.
I'm trying to speak loan officer, right?
Well, it's one of the Fed's tools of regulating the economy. It's not just interest rates.
Okay, so we have a comment from Jill. She said, it's been a year and a half of tough decisions. I'm determined to survive and thrive. And
You go,
she goes,
Jill.
AG double hockey sticks. I think hell is okay. So, I mean, everyone has a different standard of what is okay. So one of our favorite guests is, yeah, I have to remind him to behave himself. And anyway, so
Bill Dallas.
Kevin, did you have to say it? Good God, the first time, oh my God, I almost died the first time he was on here, because I really do behave on here 99% of the time. But you know what? He's in the mortgage business. It's Science News has published numerous studies saying that if you release it
You
and
release
let
it.
it out,
Go.
those people live longer, literally.
Yes.
You're releasing it. You're not on a mental, physiological. Okay, we don't need to get any more into that. But every time Science News publishes something like that, I just go, okay, I feel vindicated. Thank God. So anyway, all right. This is what I'm thinking, Bill. I keep thinking about this. I don't know how to make it happen. So tell me what you think. So I was thinking that keeping FHFA where it is and keeping the GSEs in conservatorship was a great idea once we rolled out the CARES Act, and they did such an outstanding job, we thought, during lockdown and all of that, right? Okay, what went away? Jumbo went away, non-QM went away, all the portfolio products went away. You can't keep those people in the market when things feel risky and they're not sure how to navigate it. But right now, I feel like FHA is not reliable. FHFA, not FHA, sorry. FHFA, they keep changing things. So how, I mean, and you know, Mark Calabria years ago, the previous director of FHFA, he wanted all this stuff to be privatized anyway. Is that where we're heading? And if so, how do we keep private portfolio lenders in the market when things do get risky? How do we solve this? I'm looking for a way to solve this. You see where I'm going with this?
Yeah, I think there was a question in there. It was maybe a little closer to Hamlet's soliloquy, but I think there was a question in there.
Yes, there was. Definitely.
And if he knew the answer.
Right. Well, and look, I think, you know, what we're experiencing right now is there's so much volatility in the secondary markets that private, you know, lenders, they're not rushing to get into the space. You do see some coming in that see opportunity. I think, you know, the Redwood Trusts of the world are going to see opportunity for jumbo market share, but there's still so much secondary marketing risk, volatility. Are you going to get the price for the loan on the secondary market that you thought you would get, to have people saying, yeah, let us come in and backfill what would go, you know, what the agencies would give up if, you know, so I don't think we're there yet.
Well, I know we're not there, but don't you think we need to get there somehow? And if so, how? How do we make this something where, is there any way to take any of the volatility out of this? Because that's what's hurting everyone.
No, I mean,
You have to pass it on to the consumer and have
the volatility is, you know, economy, the, you know, world politics, you know, there's just so many things that impact the global financial markets that you know, I throw my hands up.
Okay, so we're going to talk for a minute just about, because we do need to cover one more thing before we're over. I just want to send, it is not all doom and gloom out there. It really isn't. Delinquencies are near record lows, if not at record lows. Everything from 30 days to 90 days to foreclosures, they're all way, 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 way down. And so that's great. Thank God. So for the people forecasting doom and gloom, which I still hear from them occasionally, it's not happening. I am going to say that both MBA and Fannie Mae revised their estimates for where rates would be by the end of the year up. So MBA was at 5.5%. They're now forecasting our rates at the end of the year will be 5.9%. And Fannie Mae went from 5.9 to 6.6%. So I think that it is really important to try to shift the focus away from, okay, rates. I know they're important, but there is investment business being done. There are second homes being sold. There is other business out there. And there are people who have life events who need to buy, sell, refinance for whatever reason. So again, our guest next week will have quite the list of little options. And her favorite thing to do is just pull like a rate out of her ear and throw it at a broker. And if, is it as a business decision, does it make sense to do that loan? And then of course they always figure out what the actual risk is, but she'll always start high and then go down from there. So again, rates, it didn't used to be like this. It used to be, I need to buy a house. What is the rate? You didn't have all this information. And so the LOs and the consumer have been conditioned to go chasing after the lowest possible rate, completely oblivious to the idea that anything else factors into that other than what they want in that moment. And so there's so many moving parts in all of this, and we need to focus on what we can do to make it through the next 6 months, year, whatever it ends up being, and get to the other side of this hump. And we are, as Jill said, 1.5 years into it. So we've been at it for a while. It's been rough. And if you've made it this far, you can keep going, but you've got to shift what you're doing in your business. I'm doing it right now. I am doing things right now, and we're going to actually document some of that. I'm doing things I've never done as an LO. I've always been, oh my God, I was so airy-fairy and ridiculous. So if I'm supposed to have a loan, it will come to me. If it's meant to be, it'll be meant to be. It'll happen. What a bunch of hooey in this market, right? So I am having to reach out more than I've ever done before. I'm putting my money where my mouth is, where I've been preaching it and I'm doing it. And so we'll have more on that later, but it is amazing out there, but we still have 40%, 50%.
Can I go back to something you said, Audrey, that was just so right? If you tell Audrey that it's so right, she'll like, yes, please tell me more.
Oh my God, I never hear that. So please, one thing, I got one thing right.
Look, you went back and you're talking about delinquency at Lowe's. Look, we spent a lot of time today talking about risk weighting on mortgages. Blah. We talked a lot today about repurchases from Fannie and Freddie. Blah. Don't forget, this is not 2008.
Yeah.
The best mortgage loans in the history of our industry are being done right now and have been done for the last few years, which kind of makes it more BS that we're talking about risk weighting on mortgages. We're talking about repurchases. We're, as an industry, we are doing great loans and they're performing in this.
Yes.
So don't forget that.
You know this, I'm sure. We have higher average credit scores across the board right now than we ever have. DTIs, higher DTIs are not equating to riskier loans. They're not. And oh my God, they're putting huge down payments down on their properties. Like there's a lot of money, big down payments right now. 40 to 50% of residential homes don't have mortgages. There's a lot of equity out there, a lot of tappable equity, which I learned tappable equity is when they're figuring out how much equity is in the market while keeping 20% LTV or 80% LTV in the mix.
I had a client doing that the other day, taking
Isn't that crazy?
out of their investment house to buy another investment house. So it's like
10 trillion in tappable equity.
I thought you were saying palpable equity.
Not palpable, tappable. Okay. We can tap it.
Got it.
Well, okay. I'm going to just move on. Holy guacamole. Okay. Nearly every major market saw seasonally adjusted price increases. Guess which one didn't? Guess which one? It's been the same recently. Austin's still, adjusting, but everything is really moving in the right direction in terms of the market is sound and we need to focus on that. What can we close right now? What can we do? And don't just sit in your house waiting for the phone to ring or your email to pop up with someone handing a loan to you on a silver platter. That is not the market right now. Yes, Bill?
Correct. You're right again.
We had two Bills.
God, you're right again. Jeez.
Oh my God, that was two? Wow, I should just call it.
Let's just drop the mic and end the show.
Yeah, no.
Okay, so with that, let's just talk for a minute. So next week we have Trisha James. The week after that, we have Glenn Stearns. the week after that, we have Dan Habib with Mortgage MBS Highway. And so we've got a great lineup the rest of the month. And, you know, we just have to stay the course. You've got to figure out what you're going to do in your business. So get your pencil sharpened for next week, because you can make a list and you will hear what is happening out there with lenders who are closing business. It's crazy. With that being said, Wednesday, that would be tomorrow, kids, we have a 10-year note auction. Thursday, we have CPI coming in, not expected to be great. And then Friday, we have PPI. Those are 2 inflation numbers, 2 days in a row. We know those move the market. So Kevin, going back to the origins of when we started this, if you see a rate you like, lock it in.
Lock it in.
Remember that?
Oh yeah, I locked one of those in this week. It was like, oh, I didn't like it, but I locked it anyway.
Oh my God. I've seen things online where people are like, oh yeah, and I was hoping that the rates were going to come down, and now their place is almost ready to close and they're totally SOL. It's not good.
Actually, there's a little comment about the rates right now. Private money rates are so close to conforming rates. It's crazy. You could actually
find
a better deal with private money.
Well, the problem with private money is the terms are shorter. So I agree, except you have to have an exit strategy in the next 12 to 24 months. There also this week, just for fun, there's 38 billion in newly issued 10-year treasuries that are going to need to be absorbed by the market. So again, you got a lot more to lose than to gain, I think, this week, as the market rolls forward. So again, I think maybe this whole beating we're taking on the rates and this whole environment is just getting people over the hump, so that we realize that it is not 3% rates anymore. It's not going to happen. I don't know. Thoughts, Bill?
I don't go there anymore. I've been wrong. I'm always wrong. I think I need to keep those thoughts on the sidelines.
Okay, I am going to say that Bill is so very rarely wrong. And we go to you for a lot of different things, Bill. So we want to say thank you for joining us today. We love you so much. And thanks for keeping us up on what's coming next.
Yeah.
We didn't even get to VLIP and LIP and VLIP and how all that's shaken out. So we'll say
probably we should not be swearing that much. We shouldn't be talking about that, because that's a tough one today for our industry, but we'll come back maybe in a month or so.
All right. That sounds great. All right, kids. Thank you. Have a great week. We'll see you next Tuesday at 11.
Thanks, everybody. Good to see you.
Or wherever you are in the country.
Thank
you. Bye, guys.